Okay, so we'll go ahead and get started. First, I'd like to introduce everyone to Roger Ludeman. Roger has really advanced the concept of using the home equity line of credit as a primary retail product. He's designed call programs and cross-sell systems around HELOCs as a method of expanding customer relationships. These multi-relationship programs build greater customer loyalty and produce a higher probability of repeat business for the financial institution. Roger has more than 25 years of senior leadership experience in retail bank marketing. He's a past vice president of business development for an $8 billion bank where he managed retail, investment sales, consumer lending, and mortgage banking operations throughout a 200-branch network across 7 states. Roger was also a chairman of the National Marketing Exchange Forum in a group of the top financial sales and marketing representatives in the nation. He's the author of numerous marketing articles published in national trade publications, and he has been the keynote speaker at financial marketing conferences throughout the United States. So now I introduce you to Roger Ludeman. Thank you.
Thank you, Sean. We're excited to share some of the best ideas we've found to market home equity lines of credit and build a portfolio of these highly desirable assets. These are highly tested concepts that have been compiled from leading financial marketers across the country, as well as the experience that I've had with numerous marketing groups in the financial institutions that I've been engaged with for the past several years in designing and marketing this high-profile customer relationship. We'll start with history, growth, and potential of the product and the strategic product positioning. It's important to note that this product has evolved over the years from a position of being a second mortgage to that of being the home equity product of choice. The product positioning of home equities has been a tremendous advantage in that it turned what was originally a negative of a second mortgage into a very positive thing, that consumers could be proud of the fact that they have equity in their home and have the ability to borrow on that equity. There's 30 years of evolution have developed this product into becoming a leading consumer lending product and the preferred consumer credit product for higher income households, which is a very important point when you're positioning this product in your market as well as with your current customer base. It's also important to note that it has grown over the past 30 years to now make up more than $1 trillion in loans across the United States and really, again, become the preferred consumer credit product for high-income households. Key assumptions in our strategic product positioning program today will be that the equity line should be viewed as a primary relationship. Very important piece of this puzzle. It is not a byline or a byproduct of some other relationship. It is typically one that can control a primary relationship with a customer. Second, maybe only to the checking account. It certainly has high prospect and high probability for selling additional products once the primary relationship has been established with the equity line. It's also important to note that in today's world, the equity line is a wonderful link between retail and the small business sector. The small business sector really is the retail sector, but as your institution may want to build its small business assets, having a wonderful equity line of credit program is really important because a lot of small business startup ventures use their equity line of credit to start their business. And then we want to go over just briefly some of the characteristics of the equity line of credit customer. These customer attributes compared to the standard equity loan user would show that the line of credit customer is less risk adverse and understands the reasons for a variable pricing approach. Fixed rate products, in my opinion, belong with closed-end, simple home improvement loans where the amount of the payment is the key driver. In the case of the equity line of credit customer, again, that is less risk adverse, there is a built-in customer affinity for variable rate pricing and the ability to build a long-term relationship that can be renewed as the product is termed over a 5-year period. Pricing and packaging impact different users, and that's why today's focus is really on the equity line of credit and the fact that it is a primary product relationship with the customer. You'll also notice we go through today's information that there will be a major focus on the variable rate line of credit. And certainly one of the most important things is to seize the opportunity at this point in time in the marketplace because of the position of the prime interest rate. The case study that we'll be going over today with you involves personal experience that I've had with a $2 billion Midwest financial institution. The institution had approximately 50 branches, and this program was executed from 2000 to 2010. In the beginning, we had steady initial growth, but once all the elements were put in place, it really took off. And the key is solid, continuous quality growth is focus and managing all the elements of a systematic approach, not just any individual one item. In the case study, the results over a period of time, and we really had several years that were greater than this and some that were slightly less, but they averaged out to more than $60 million per year in new equity lines with a 52% drawdown rate. The portfolio over that period of time grew to more than $300 million in high-quality assets over a period of 10 years. And this was a product line that obviously became a very major and important part of our overall asset management process. How did we do it? Well, the key element is buy-in, grasping the value of HELOCs in the fact that they are primary relationships, noting that they are a safe and attractive product, and certainly the profitability component is a big attraction for financial institutions as they look at this process. Never underestimate the value of a checking account, but the next best thing is a home equity line of credit. These are traditionally very sticky products with great cross-sell capability and long-term continuity for greatest profitability. How did we do it? Well, we looked at all of our constituencies and really designed it obviously for a major customer affinity. However, we started through the execution by really embracing all of the parameters of our asset liability committee and making sure they were committed to this product from a long-term point of view. This is particularly the case to make sure that senior management is committed to the program, and ELCO is the key to that. And then certainly we wanted to make sure all the loan officers were embracing the product. That would include mortgage officers as well as those that were frontline retail banking loan officers, whether they be personal bankers or specialists in the lending area. But certainly all of them are key to the process. And we did not exclude the staff. We wanted to make sure the entire staff of our institution fully embraced the product and understood the importance of it as a primary relationship with the customer. Pricing and packaging were the other keys that we looked at carefully, and again we kept a very simple package that could be embraced by everyone. And then obviously one of the most important components of the process is the marketing piece of it, and particularly the success we had with database management and direct marketing. We wanted to make sure that everyone in the bank took great pride in participating in the offer, selling, referring, maximizing return on investment both in terms of time and money. And finally, tuned direct marketing, again, was a key part of that overall process. In designing the product, as is the case in all marketing initiatives, success starts with designing a product that customers embrace and the offer is strong enough for them to want to take action and certainly have a sense of urgency to take action. In designing the product, we were very careful again to start with our asset liability committee and work with them to design something that they could very much embrace and support from a senior management point of view. We had variable rate products that were in an 80 to 90% loan-to-value category. In some cases, we took them to 100% in very known market situations that provided for younger participants in the program, but typically focused on the 80 to 90% LTV. Very important element to note here is the 8-year rule of thumb. After a lot of years of research and information that came from the National Marketing Exchange Forum and a number of other research organizations in database comparisons, the primary difference between a customer that can utilize and get by with an 80% LTV maximum is that they are approximately 8 years older and therefore have established more equity than the customer who needs 90% or in some cases 100%. Nationally, there seems to be a fixation currently on limiting the amount to 85%, but certainly as the housing industry and the overall economy grows and improves, we feel that will move up. And again, careful targeting and underwriting can open up new avenues of safe growth. It is always, as always, rather critical to know your customer and to make sure that you focus on the avenues of safe growth. In looking at the rate, simplicity is really a key driver of everything we discuss here. The variable rate is a key item in terms of protecting the bank and getting full support from the ELCO management area. Interest rate risk management becomes a key part of this, and certainly the ELCO involvement is supportive of this process because we highly recommend a product that is benchmarked to Wall Street Prime, and certainly that is required by law, obviously, but we've seen various people over the years try to benchmark to Treasury rates or some other benchmark that wasn't as public as Wall Street Prime, and we really believe that Wall Street Prime is the secret to success on this. And certainly a 5-year renewal period is very, very important. We think that a rolling look into the loan every 5 years is very important. It allows the institution to take a look at the loan, to restructure, but highly recommend that all of these be renewed as often as possible, and certainly in so doing you'll often see that they will last as long as 10 to 15 years in terms of duration if they are automatically rolled after a look-in at the 5-year time period. This is also, again, as we've mentioned, the perfect window to market. The simplicity of this product can sell the most is the key to acceptance by loan officers and customers alike. All of your loan officers will like something that's ultra simple, that they don't have to worry about 4 or 5 different versions of it, and the 5-year window again gives the financial institution the opportunity to reprice or restructure each period if there's something in the loan relationship that they want to take a look at and reconsider. Right now is a very, very prime time to be promoting this product. In fact, we look at this as a status position that's comparable to 2001 and 2002 when interest rates were extremely low during that time period as well. And as we go through this process, you can see with the prime rate at 3.25, it's going to be an extremely attractive time for customers across the United States to be participating in this product. As Ben Bernanke quoted in the June 20th, 2013 edition of the Wall Street Journal, rising home prices are increasing home wealth and strengthening consumer confidence and spending. Pulling back on bond buying programs, but still not pushing short-term interest rates up until 2015 seems to be the philosophical position of the Fed at this point in time. As a financial institution, it would be our prediction that you have about 18 months from this point going forward to really begin building a strong base of equity line of credit portfolio, and certainly you can take that base then into 2015, 16, and 17 and continue to make money on this high quality asset and the portfolio that is developed over the next 18 to 24 months. In designing the product, access is a key ingredient. Certainly we feel that checkbook access is one of the most important, and this is a wonderful opportunity to do some branding for your financial institution. We love the terminology of equity access, and it is available to institutions that want to implement this program. Certainly credit card access with younger customers these days is becoming more and more important, but the checkbook access has them focusing more on major purchases and less on daily purchases just for the home or for maintenance purposes or something like that. The checkbook is the one that allows them to do major home improvements as well as purchasing automobiles, education, and various other things, which is where you would really like to have them using this particular product. From an ALCO point of view, this streamlined product is one that can easily be approved and certainly has a lot of major advantages from a compliance point of view. The 90% LTV is easy to explain. Currently, across the United States, it's very interesting, and I think it's partly because the prime rate has been at the same level for so long. but there's almost a consistency across the United States that if you want to be aggressive with this product and yet not give a lot away, something in the vicinity of 74 basis points over prime is a very good pricing position to be in. Now, certainly a lot of the mainstream major banks across the United States are able to bring in more than this in terms of differential over prime. And we've seen many other smaller institutions on both coasts as well as in the middle of the United States offering this at a lower rate than this amount. But we've done a lot of research and we feel that this particular purchase point is very good, and most customers will have no issue with a 74 basis points over prime offer, particularly at a 90% LTV. We would leave it then up to the institution. If you wanted to offer an 80% LTV at a slightly lower rate, say 349 or 374, that certainly could be done, but it allows you to market a 90% LTV and get the multiple maximum use out of the promotion and pricing that you're doing to the prospects both in-house and those that you may direct market outside of your actual customer base. Preparing your staff. It's very important to note that the frontline training is a key part of this process. Certainly we're not looking at something as simple as this product is that should take a great deal of technical training, but we do think it is important that all of the staff, particularly frontline staff, go through a fairly comprehensive orientation to make sure that they understand why you're offering the product, why it's priced where it's at, why it is of value at the point that it's at, and then certainly you're going to want to build this in a strong way in terms of orientation and additional training for your personal banker delivery system. It's certainly my recommendation after years and years of promoting this product that would point that most mortgage loan officers want to stay focused on the first mortgage, and it also makes it a lot less of a compliance issue if the equity line of credit product is assigned to the personal bankers and not necessarily something that is required of the mortgage loan officers to do. Certainly with rates starting to edge up a little bit in mortgage lending, mortgage loan officers may have more time to do this, and there's certainly nothing wrong with them marketing equity lines of credit, but I've found over time if you really want to have a major focus on the product, let the mortgage loan officers do the mortgage loans and allow your personal bankers to focus on the equity lines of credit that can be done in much higher volume if there's a greater focus on them. Finding the profitable customers is really one of the key elements of the process that we're going to talk about today. It's very important to market this product to the right prospects, certainly those who have a need as well as have payback capability. As we look at markets across the United States, we're going to be somewhat generic in our description today. However, each market is analyzed individually, and certainly home values and the rebound that has taken place. We've seen some markets that were down as much as 60%, but have rebounded 35 to 40% across the United States. The process that you go through there is one that you have to be very careful on how you look at the prospect base, those that are both inside your current customer base as well as those that would be outside the bank customer base at this point in time. We want to aim for those, generally speaking, again, with exceptions to major markets, especially on the East and West Coast, but we want to aim for markets in the range of $100,000 to $250,000 in home values. We're certainly looking to try to have most of the emphasis on those that have 20 to 30% equity available up to whatever LTV maximum you will use. And certainly you can go higher than this, but when you do go higher, you have to be careful that you look at the market analytics very closely to make sure the market merits going higher than that, because oftentimes when you go too high with the equity line of credit, you'll be bringing in a number of customers that simply want it as a cushion and therefore do not use it. And a very key ingredient, especially as you use no-fee offers and a sense of urgency on your process, you want to make sure that you have customers coming into the system who will be using the product, and try to get your utilization to the national average of 50%. 52% would be better, and certainly 54% is achievable. So those are the parameters that we go after as we look for the sweet spot for all of the direct marketing and the customer prospect base that we will be going after both inside the financial institution as well as in the general markets around those financial institutions. In terms of media, we focus heavily on database management and direct mail, both inside the institution as well as outside. Certainly in kicking off the program and announcing your promotion rates in terms of having a stable continuous rate offer and looking at the parameters, especially showing the sense of urgency with no fees for the first 90 days or the first 180 days of your promotion time period. We do recommend some limited print to kick this off. That will give you the additional coverage you need in order to provide general knowledge of the product in the marketplace. And then certainly one of the top issues is making sure your staff is fully oriented toward the product and understands how valuable it can be to the customer base, because in many cases we're going to want them to do personal contacts not only from point of sale inside the bank but also via telephone contact that they would make to the customer base as well as prospects in the general market. From an internal point of view, very important to have this take a center stage position in terms of sales promotion, posters, signs, loading up your web banners, making sure you use social media when and where it is appropriate to do so, dealing with emails and follow up with your entire customer base as well as those outside your customer base who may have expressed an interest in the product over a period of time and are part of your overall database. The entire system provides focus and long-term success as you implement it very, very carefully. It's important to note as we look at a couple of the ads in the program that we're recommending in terms of graphics and presentation from a production point of view, it's important to note a recent Radin survey that the Radin Group is a highly refined and highly respected national research organization for financial institutions. And recently they released a major survey. Oftentimes you'll see financial institutions marketing their equity lines of credit, and they'll be focusing on loan consolidation, debt consolidation, or they'll be focusing on the fact you can buy a car or some other particular element that they think shows the versatility of the equity line of credit. And we've found that over the years the most important, safest, and best way to approach this is really to focus on home improvement. Because we found that both the demographic and psychographic nature of the product leads one to really focus on the home improvement area, and the recent Radin study shows this very, very closely. And as you'll see by our mock-ups of the advertising and direct marketing components that we recommend for this, not only is home improvement a big piece of the presentation, but it's also highly oriented toward the psychographic aimed at women and home improvement, because women really drive a major part of this decision-making process and also drive the sense of urgency to take out a home equity line of credit in order to provide for home improvements that they may want their family to undertake. These are the two biggest components of the process, direct mail and limited newspaper. You'll see that we have a very efficient postcard with a simple message, and then also add in quarter-page ads as an introductory process that is part of the initial program. And then you'll also notice that it is rate focused with a 3.99% interest rate. So these are just samples of some of the direct mail and limited newspaper that can be provided with efficient postcard and simple message, and again the quarter page size ads to introduce the program, and then follow up with additional direct marketing as the season continues. And speaking of the season, very, very important to understand that there are really two primary times to market this product. They are in spring and early summer, and then late summer and fall, both almost equal in their priority in terms of moving forward with your product lineup and seeing success. Again, critical component is to operate all the key elements of the system, and then making sure your employees are fully trained and oriented toward the product, and then really making it a primary product position during these key seasonal times. Late summer and fall are coming up, obviously, and we are preparing now for several clients getting ready for the August, September, October, November timeframe, which is a really peak season for marketing this product. And we typically recommend 3 mailings for each season, or a total of 6 direct marketing cycles throughout the year. Key to this whole process is to think long-term, build consistency and continuity. It's essentially a highly targeted program that can focus then on the 6 top months of the year to really get the greatest, fullest advantage of this overall product lineup. In ensuring success, best practices are outlined by the following. Number one, in ensuring success, we feel very, very strongly that you need to have program commitment, and that's why we have the asset liability committee involvement, senior management, taking a new look at your product structure, keeping it simple and streamlined, but especially building something that senior management can be very proud of and committed to, and we really feel that over the long term this is a critical component to building the equity line as a growth program. Secondly, the product design and business planning of this program is very, very important as well. You need to approach the equity line as a key lending expansion opportunity and not just as a byline to consumer lending or an add-on to a mortgage loan program. It really needs to take primary position within the financial institution and certainly focus on simplicity for customer and lending employees as well. Lending employees looking at a very simple product will embrace it much more, and they will also sell a lot more of the product if it's simple and easy to understand and particularly carefully set up so that compliance is not an issue. The offer, pricing should be aggressive. We really like the idea of setting up aggressive, standardized, fair, and understandable pricing. Most importantly, it should be approached from a long-term position of consistency and continuity. This essentially eliminates a lot of the promotion rates, a lot of the MICE type you're going to need to have for compliance purposes, and it streamlines the process so that over a period of time the offer can be managed and adapted, but it can also stay fairly consistent. From a compliance point of view, the straightforward design simplifies the compliance, and as we mentioned, if this is carefully reviewed and it meets all your guidelines, you can keep this so simple that it will benefit everyone in the bank, everyone in the credit union, everyone throughout the financial institution to provide for a simplified overall process. And then as the process goes here and the seasonality that we're looking at, direct marketing and database management are critical elements. We also recommend limited exposure in mass media to introduce the program, but to focus on direct marketing and database management as the primary driver over a long period of time. Over the years, one of the most successful components in the best practices has been sales systems and incentives. We love to bring to the table ideas for you that can set up a referral program for all of your key people that will be making referrals to this process. Many of your people who are in the back offices, in operations, in deposit operations, wherever they might be, are going to know of people that need an equity line of credit, and it's important that they be part of the team focus to make this a major difference over a long period of time. And then, of course, contests, sales programs, and everything for your frontline people, particularly your personal bankers, is very important. Merchandising and promotion. During the peak season sales, we provide as part of the package a systematic approach that includes a major emphasis on in-store promotion, signage, and all other merchandising elements. That entire process brings great value to the system and provides for an overall initiative that gives everyone a lot more comfort level in doing the right thing and bringing it to the attention of the staff. Staff orientation is very important. We don't necessarily recommend doing highly technical training for this. Hopefully your product is well known enough to your sales staff that the technical training can be done, but all of the staff needs an orientation in order to provide them the reasons why you're doing this and why it's important to the financial institution. And then, of course, goals tracking and measurement systems are part of the overall process. Setting specific goals for success and measuring with progress reports, very important to the long-term success of the program. From a best practices point of view, the last item is to position the product as a primary relationship with potential for major cross-sell capability. Once you decide that the equity line is a gateway to other relationships, including checking, small business, mortgage loans, investments, and other areas, the sooner you do that, the more you're going to have a higher response level and greater success over a long period of time. That covers the key points that I wanted to make in the webinar today. And we have opened this up for questions if anybody has any questions, and we can cover those at this point in time.
Roger, we did have one question about the recording of the session. This session was recorded, and we will make that link available within the next week or so.
Good.
We'll email that link out to everyone that registered so they can share that with people that were unable to attend.
One question we get often has to do with the fact that the front line gets a lot of pressure from customers right now to do fixed rate equity lines of credit, and I've felt that pressure before, having headed up retail banking and particularly in the mortgage area. And my recommendation wholeheartedly is to stay away from setting fixed rate alternatives right now on your equity line of credit. Stay with the variable rate. The particular client that you're after is less risk adverse and understands how variable rates work, and they're very open to using variable rates. And so usually my recommendation is take a leadership role and make sure that you stick with the simplicity of the variable rate product.
Roger, we did have one other question asking if our program had any social media support.
Yes, this program certainly can be supported from a social media point of view. There are a number of web-based support systems that are part of this that include web banners and other electronic media. In addition to that, we have some of the best people available here at Acton that are part of the social media development group that can provide support, recommendations, and set you up for a system that will help you implement from a social media point of view.
Great. One other question that we had come across was asking about the rate. The ALCO committee wants to do an intro or a teaser rate, and our strategy says to stay away from an intro or teaser rate. Could you please expand on why we recommend against a teaser rate?
There are two reasons for that. Number one, teaser rates have been overused and overcomplicated over a long period of time. Customers have gotten way too smart to be really very impressed with or interested in teaser rates. When you do a teaser rate, you have to assume that you're going to have to double or triple up on your compliance process. We would much rather see through a sense of urgency program that you use a waiver of fees for a short period of time, or tell them that there's a window of opportunity before, if they do the loan before December 31st, to get a waiver of fees and not deal with the complications and the sometimes negative feedback you get from customers for doing promo rates on the front end of the loan. So our recommendation strongly is to use a benchmark to Wall Street Prime spread, do it aggressively, and be set and ready to roll. And then at a point in time when the window of opportunity changes, you can change your parameters for the prime benchmark, but we think as long as you've protected yourself with a certain number there, and you can do a minimum rate if you'd like to do that, but doing it that way rather than with a promo rate is a much preferred method. We have one other question, and we'll get to it here.
Someone on the webinar kind of painted themselves into a corner with an intro rate of 6, and after a few years, after 2 years, many of those loans leave. And so they were wondering about options for a strategy to retain those from going away after the intro rate's over.
Yeah, my recommendation, strong recommendation, would be to make sure you keep those on your database and your direct marketing list. Set up what you feel is an appropriate approach to them that would be beneficial for your financial institution. And certainly if you wanted to email us in, I could recommend particular pricing that you should use on it. so that you could direct market to them and provide some protection in maintaining that portfolio. You certainly bring up one of the biggest reasons for not doing promo rates on the front end, and that is that a lot of that audience is so savvy that after the 6-month intro rate expires, they'll look at other alternatives. Sometimes even if you have a penalty clause, which you should not have in my recommendation, a penalty clause for leaving after the loan has only been open for 9 months or 10 months. Those kinds of negative things where it's $250 if you close the loan before 1 year, as an example, tend to be obstacles both to your sales staff and to your customer prospect base, and that's why we highly recommend keeping it very simple on the front end, doing a benchmark rate and moving in that direction rather than using the promotion rate. But certainly email us with your specific data relative to the rate that you're dealing with right now on the promo rate, and we can immediately feed back to you some pricing recommendations that you can use as you go forward in dealing with that particular prospect database.
Not sure if the person is still on that asked the question about the call center, but we had a question come in asking if we need a call center, why or why not?
A highly trained and expert call center is a tremendous advantage for something like this. However, it is also very, very possible to train and develop the frontline staff to do call nights to your key prospects and make this even more viable if you use actual staff to do it. So it works either way. You can use call centers, or you can use training, development, and orientation for your inside staff to make the calls, make the prospect calls, and frankly, that's the way I did it. It was more real. In fact, in many cases, a lot of the frontline representatives knew the prospects that they were calling, and it helped develop it. So it works either way. A call center that's highly trained and developed, certainly for larger banks and credit unions, is a tremendous advantage, but it can be done either way.
Looks like one final question came in. What about requiring a checking account to get this rate?
I would recommend against that. The checking account acquisition should never be a forced acquisition. You want the checking account to be one that they've decided they need a checking account with you, rather than being forced into the checking account by getting the rate. It certainly has been done and will continue to be done across the country in different places. But my personal recommendation is to run the checking program independently from that and use your cross-sell capability to sell the checking account, rather than forcing them to open a checking account that may set dormant during a period of time and raise your operational and overhead costs. I prefer to see it done with a customer that wants the checking account versus being forced to open it just to get the rate. Sean, I think that wraps up all our questions that we have for today.
Yep, I believe that's it. So again, feel free to reach out to us if you have any additional follow-up questions, comments, concerns. And thank you very much for your time today.
Thanks, everyone. Email us if you have any questions. We'd be happy to follow up with any other details that you may wonder about. Thank you.